Good evening, ladies and gentlemen. Thank you for being here with us and welcome to the webinar. My name is Lacey, member of Wealth Team HSBC Malaysia, and it is my pleasure to be the moderator today. Before we begin, we want to make sure we address your questions. Therefore, we have prepared a Q&A box on this platform. You may submit your questions anytime, and our speaker will address them at the end of the presentation. Ladies and gentlemen, as the global economy has moved from the reopening to the mid-cycle phase, will the Fed's faster tapering and earlier interest rate hikes threaten the risk rally? How should investors manage uncertainty over the Omicron variant, supply chain disruptions, and inflation? How does Asia differentiate from the rest of the world in terms of growth and recovery outlook? Find out how to position your portfolio for the big reset driven by the world's gigantic net zero transition and digital transformation, as well as where to find the best opportunities from the mid-cycle growth. Now, may I introduce to you our speaker for today, James Cheo, Chief Investment Officer, Southeast Asia for Private Banking and Wealth at HSBC. James is a member of the Global Investment Committee for Private Banking and Wealth Management and also a member of the Regional Investment Committee in Asia. In his role, he spearheads the development of investment strategies across all asset classes for private banking and wealth management clients in Southeast Asia. Prior to rejoining HSBC Private Banking, James was Senior Investment Strategist at Bank of Singapore, where he was responsible for asset allocation and thematic research. Before that, James assumed investment strategist roles at Barclays Wealth Asia. From year 2004 to 2009, James served as Senior Economist at the Monetary Authority of Singapore, where he was part of the team that formulated policy actions for Singapore during the 2008 global financial crisis. With his knowledge and wealth of experience, his investment views are frequently sought after. He has established a strong media profile with appearances on notable financial media, including Bloomberg, CNBC, Channels News Asia, Channel 8 Mandarin News, and printed publications such as the Financial Times, Straits Times, and Business Times. James graduated with first-class honors in finance from Nanyang Technology University. He was awarded the Chartered Financial Analyst Charter in year 2007. Without further ado, please join me to welcome James.
Well, thank you, Lacey, for your very wonderful introduction. And also, thank you, everyone, for attending this webinar. Well, it's with my great pleasure that I want to share with you how I view the world for 2022 and beyond. And really, the title of this presentation is The Great Reset. Clearly, the pandemic has reset our world into three dimensions of sorts. First, a more indebted world. But also at the same time, it created a more digitally connected world. But the good news and the silver lining of this pandemic is that it has made our world much more sustainable. And along each of these dimensions, each of this world, I want to spend some time talking about the implications and the investment strategies and themes around all these three worlds, as how we call the Great Reset will be. What's clear is that the world became much more indebted. Debt to GDP grew more than significantly. And for last year, the debt to GDP almost hit 400% of global GDP. And what we know is that whenever you have debt, you are actually borrowing from future growth. And so what it means is that because of the debt overhang, future growth is going to slow down significantly. And I think that's going to be the situation we're going to see going forward. And also what's clear is that the peak of growth that we have witnessed over the last 2 years or so, in which that V-shaped recovery we have seen, is likely to be behind us. And that growth going forward is going to start to be more normalized, but nevertheless still fairly healthy. We are now in the kind of a mid-cycle growth stage, in which we think that growth is still going to be healthy and solid. But of course, it's not going to be as fast as what we've experienced last year. So we think that global growth this year is going to grow at 4.1%, and that's quite high by historical standards. And in the case of the United States, we think that the US can still grow at around more than about 3.6, 3.8%. So that's going to be a fairly robust growth if you look at it from a historical perspective. Where we think that growth will be stronger in 2022, it's going to be in Southeast Asia, because Southeast Asia is going to experience to us a growth spurt, and it's going to be growing faster than 2021. This year, we think Southeast Asia as a whole can grow at 5.2%. And I think that's really because Southeast Asia is reopening. Southeast Asia is living with the pandemic. And also many countries in Southeast Asia have ramped up vaccination rates significantly. And I think it sets the stage for Southeast Asia to reopen and for consumption to pick up once again. But more importantly, I think in Southeast Asia, what we have seen is also that this year is the year in which you're going to get the implementation of the Regional Comprehensive Economic Partnership. It's the biggest trade agreement in the world, and it will reinvigorate investment spending in Southeast Asia. Over the last 2 years, a lot of the pandemic, a lot of the investment spending were actually stalled because of the pandemic. And we think that in this year, all these investment spending will be re-accelerated and will be implemented. So I think that's going to be a lot of support and a lot of very interesting investment themes within Southeast Asia that investors should explore as a result of this growth acceleration in 2022. But of course, one of the reasons why we are in a more indebted world, and really governments across the world, especially in the US and also in many developed economies, is that the rise in debt is really largely through government spending to support the pandemic. But to finance the debt, a lot of the debt is actually financed through quantitative easing or central bank printing money. And as a result, it created huge amounts of liquidity in the market and in the economy. And therefore, it led to inflation getting extremely high by historical standards. So in the US, inflation right now is hitting 7.5%, more than a 40-year high. But I think one very important aspect is that we think that a lot of this inflation is not just based upon monetary conditions, but a lot of the reasons behind why this inflation is occurring is to do with supply disruptions and supply bottlenecks as a result of the pandemic. And with reopening, these supply bottlenecks should ease. And we are seeing it in specific markets. You have had shortages in Asia of electronic chips. You also in the United States, one of the issues is that there is lack of used cars, and of course, also in terms of the labor market in the US, we saw quite a bit of a rise in part-time wages as workers are hard to find, especially as the country reopens its service sector, especially in restaurants, etc. So these are where we think the supply bottlenecks are occurring. And as a result, what we think is that going forward, especially in the second half of this year, as supply bottleneck starts to adjust for itself, as demand starts to slow down as well, you're going to see inflation fall. And I think that's going to be a trend that a lot of investors have not yet really looked at. And of course, with the fall of inflation, it's going to have an implication of what the Federal Reserve will do. We think that this year, the Federal Reserve would very likely be raising interest rates. And of course, the amount of interest rate increase we think is that they're going to increase interest rates first in March by 50 basis points. That's 0.5%. And I think very importantly, along the years, it's going to raise it in 4 tranches, 25 basis points each for the full year. So for 2022, we think that the Federal Reserve is going to raise interest rates by 1.5%. But bear in mind that a lot of this increase in interest rates is already priced in the market. So when you look at the bond markets, the rise in bond yields, etc., has already taken into account what the Federal Reserve will do. So from that perspective, the implications is that we think that, number one, very importantly, is that because of how we think interest rates will be and how we think inflation trends will be, we don't think that the inflation risk will derail the whole stock market rally. Yes, this year's stock markets will find a grind higher, a little bit more difficult, but nevertheless, it will still go higher, really because economic growth is still strong. We have seen a very strong bull market in stock markets across the world over the last 2 years. But I think this strong bull market probably is now an aging bull this year, which means that stock market returns will still likely be positive, but not as much as in previous years. As interest rates starts to increase, what investors should also do is to start to position into sectors that can benefit from rising inflation as well as rising interest rates. And we think that financials, global banks, for example, is one area to be in. We also think that energy sector is another area that we think the investment opportunity is quite good, especially as interest rates are rising. And also we think that consumer discretionary sector is also good as companies and countries reopen. You're going to get more consumption spending to go on. So I think these are where we think the sectors and opportunities are. But I think one very crucial aspect is that investors cannot ignore the technology sector, especially if you have a long-term view. Because what the pandemic did was to bring about and make the world much more connected digitally. And as a result, the technology companies are the key winners of this pandemic. And this trend is not going to go away because the pandemic kind of brought a crash course on digital. It made everyone, the entire population in the world, work, live, and play digitally, now online. And I think that kind of started a huge shift in consumer behavior. And therefore, I think the technology sector will continue to look attractive despite being sold off recently. And therefore, I think quite a lot of interesting opportunities are being opening up here. There are many teams that we can play in the technology sector, but I think right now we are connected through Zoom. Zoom is great, but it is very much a two-dimensional platform. The interactions are very much two-dimensional, and I think the future of work and play is going to be very much three-dimensional. It's going to be built on 5G and even 6G, and that it's going to be in virtual worlds such as in the metaverse, where everyone can have an avatar, and the interactions are going to be much more engaging. So I think that's where new investment teams and opportunities will start to present itself. And of course, with technology, that whole green transition is going to be very important, especially the themes of energy transition, the electrification of vehicles, and also how smart cities, and buildings are going to be built in future will have to be much more sustainable. And therefore, this creates a very interesting investment team in the years ahead. Because what the pandemic did was to make the world much more sustainable. It brought the world together in wanting to fight climate change. But also, more importantly, what this pandemic also taught us is that companies have to learn to adapt. Why I show a picture of a dinosaur and crocodile is that dinosaurs, in fact, crocodiles are from the dinosaur age, but crocodiles are able to adapt. And therefore, they survive through millions and millions of years of evolution, really because they are able to adapt. And I think in the years ahead, companies that adopt ESG principles or use ESG as a key part of their business strategy will be more adaptable and more resilient. ESG essentially is environmental, social, and governance factor. And I think increasingly is getting much more important, really because more and more companies and countries have pledged towards carbon neutrality plans, and much more investments have been slated towards sustainable investing. But a lot of the reasons why governments are leading the green charge are also really because primarily, if you remember, big countries like even in China, they face severe air pollution issues in their cities. And there is a need to transit from coal-based energy into cleaner, renewable energy. And this is almost not just, it's something that they have to do, and they have to do it very fast. And these are one of the reasons why governments across the world are pledging to be committed to making this whole green transition. And importantly, I think what the pandemic also taught us is that environmental now means much more to corporations. And we have seen that many companies have embraced environmental as a key part of their strategy, whether it's automakers or even for us at HSBC, we have also pledged our net zero plans as well, and being very ambitious on it to change and partner all our business clients and customers across the world to become net zero as well. And I think this is a very big statement for a financial institution. But also what the pandemic showed is that social now means much more, because really at the peak of the pandemic, you have had companies that actually rejig their supply chains to help consumers or to help people, especially at a time when there was a shortage of hand sanitizers. Some of the luxury companies in Europe rejig their supply chains to produce hand sanitizers. And these actions were actually well rewarded in terms of loyalty by customers and also by investors. So social really means much more in a post-pandemic world. And therefore, in this post-pandemic world, we are seeing big resets that are occurring and many interesting themes that are emerging as a result. And one of the biggest opportunity and themes that we are seeing is actually in the sustainability revolution, where we are seeing innovations that are occurring in battery technology, electric vehicles, adopting data and AI in supply chains to make supply chains much greener, that reduces carbon footprint. But also we are seeing renewable energy becoming more efficient, that the cost of renewable energy is starting to fall. And therefore, with the rise of green hydrogen, for example, solar power, and also geothermal, and also with wind. So these are many ways in which where we see the opportunities are in the entire sustainability revolution. So I think this year is still going to be largely a fairly positive year for risk assets. We think that investors should keep a globally diversified portfolio more than ever, really, because we are in a mid-cycle where there's going to be a little bit more volatility, but growth is still going to be fairly supportive. So we still think that equities would very much do better than bonds this year. And of course, within equities, we think the opportunities is in the US market. And also, I think in Europe and parts of Asia, we think it's still going to look very exciting for investors. One very important feature is that in terms of the sectors rotation, we think that the sectors that will do well this year would be especially in the early part of this year. It's going to be in the value sectors, especially as interest rates rise. You're going to see banks, financials outperforming, really, because you remember banks have been living under a kind of a zero interest rate environment for the last 5 to 10 years. And with interest rates rising, banks' net interest margin can start to become a key pillar of revenues. But also increasingly, where we think the opportunities are, it's also as inflation gets higher, you want to be exposed to the energy sector as well. And of course, you want to find dividend plays, whether it's in the REITs or in some of the quality companies, in banks or in energy, to get that income from equities, which is very crucial. But I think what's very important is that if our view is right, that inflation should start to fall in the second half of this year, and bond yields, yes, in the short term, it can trade higher. US 10-year can trade at around 2% or higher. But eventually, if it starts to anchor and stabilize at around 1.5%, you're going to see a rebalancing towards technology. And technology, we think, will be one of the main winners of the post-pandemic world. And I think a lot of the pullbacks in technology stocks, whether it's in the US or China, is getting quite interesting for investors. So that's where we think in terms of the equity markets. And of course, in terms of the bond markets, you want to be managing the duration risk of your bond market, given that in the short term, the next few inflation reading is going to be high and perhaps volatile. And therefore, you want to keep your bond duration low. But at the same time, you also want to look at exposing, having some bond exposure into floating rate bonds in which these coupons can reset higher in the event of higher interest rates. So I think in a nutshell, you want to have a very strong, diversified global portfolio, but also you want to look at satellite themes such as in Asia, such as the digital, and also the sustainability revolution. So I think with that, I will take a pause here and I'll pass the time back to Lei Sim to moderate the questions that you all might have for this session. So over to you, Lei Sim.
Thanks, James. Thanks for the market insights. Yeah, so we have gathered a few interesting questions here. So I shall kickstart with the first questions. It's on US equity. So will US equities stay relevant despite the tightening environment? And should we be selective?
Yeah, well, great question. I think the US stock market can still go higher because if you look at the earnings projection in the US, it's still very solid. First and foremost, US growth is still going to grow at around 3.6 to 3.8%, and that would translate to double-digit earnings growth for many of the US companies. But what's important is also that the whole bull market that we saw over the last 2 years, it's probably behind us. That bull has aged. It's going to be an older bull, so the upside associated with US is probably lesser compared to the last 2 years. It's going to be a positive year, I believe, in the US market, likely high single digits, even perhaps it could even reach low teens returns. But by and large, even as we look through history, even when Federal Reserve raised interest rates, typically in a rate hiking cycle, it's normally not negative for stock markets. It's usually positive for stock markets because when central banks increase interest rates, it's because the economy is strong. And we are still very early in the rate hiking cycle. So I think, yes, you can still be invested in the US market, but you want to look at sectors that we think, at least in the short term, will do well, such as in the energy space, in the global financials, in the consumer discretionary. And also, I think opportunistically, selectively, look at some of the technology names that have been sold off quite significantly because of the rising interest rates.
Great. Okay. Well, U.S. Federal Reserve will be tightening monetary policy, while China is expected to be more accommodative. Do you foresee further rate reduction from China's central bank?
Yeah, well, that's a great question. I think there is a policy divergence between the US and also China in terms of monetary policy. So in the US, we think that the US central bank, the Federal Reserve, is going to first front load the interest rate increase 50 basis points in March, and subsequently 25 basis points 4 times over the course of 2022. So that brings it to 1.5%. And next year, perhaps another 25 basis point increase, another 50 basis point. So that's where I think the US is trying to do, because inflation is fairly high now. And if we are right, inflation should start to fall and normalize as demand falls. And also, whenever central banks raise rates, it's like pressing the brake on the car. So they will tap the brakes very gingerly, very gently, so that the economy slows down. So I think that's going to be really what is happening in the US. But in contrast, in China, China is on the other direction because economic momentum is actually slowing down in China, in part also due to the pursuit of the zero COVID policy, but also I think generally across the board, there is a slowdown in economic activity, and therefore the central bank in China is actually easing monetary policy. That means they are cutting interest rates, they are increasing credit to the economy so as to cushion any economic slowdown, which is happening. So I think that's what's happening in China at the moment. But nevertheless, I think the policymakers would likely, if there are further signs of economic slowdown, it's very likely that China would increase some more fiscal support as well, in addition to monetary support, in the sense that they can actually cut interest rates and they can even introduce more fiscal spending on infrastructure and investment. So those are the levers that the Chinese government have to support growth and to kind of engineer a soft landing of its economy.
Great. Okay. With the price weakness in China capital market, this appears to be great opportunity for long-term investor where the growth rate from China remains strong and supported by cheap valuation. Do you think 2022 a return of China?
Yeah, great question. I think for China, at this point of time, we are neutral on China, really, because first, the economic momentum is actually slowing down. And yes, the government has eased policy. We are seeing some signs that credit is entering into the economy again, but the whole rebound is not yet broad-based. So in terms of the signal-wise, it's not yet clear for us to go overweight on the Chinese market. But having said that, valuation is actually very attractive in China, given the regulatory uncertainty that we've seen last year. And in terms of valuation, the Chinese market does present a very interesting market. But how we want to invest in China right now is that if you don't have exposure to China, you can look at some exposure that is aligned with the policy tailwind of China. For example, you want to be aligned with companies in China that are adopting technological innovation and upgrades, a lot to do with semiconductors, for example. So that's where we think the opportunities are. And also, of course, China is embarking on ambitious plan on the green sustainability revolution. So Chinese green revolution is going to be another theme that investors can actually look into and consider. But of course, for investors with longer term horizon, if you have a view of 1 year, 2 years, 3 years, and you have very little exposure to China, I think this is a good time to start looking at it and kind of invest and find opportunities there, because over the long haul, the structural story of China remains that the rise of the middle class, consumption, all these things will do very well in China over the long term. Thanks for the question.
For those clients who already have exposure in China, is it wise to top up now? Or otherwise, what is the duration to hold if there's no dollar cost averaging done?
Yeah, well, I mean, there are investors that have exposure to China right now. I mean, understandably, but I think where the regulatory uncertainty, you want to kind of rejig some of the sector exposure because as China moves on this whole common prosperity theme, short term is going to create uncertainty, but over the long term, if they get the policy right, it's going to increase the entire economic pie. It's going to create a larger middle class. It's going to create a stronger and more resilient economy. But so in the short term, you want to kind of avoid some of the sectors, for example, which are labeled as so-called the three mountains that Chinese want to provide those services, is whether it's healthcare, property, and education. These are the sectors that the Chinese government wants to provide, make it accessible and affordable to all. And I think it's a right move in many ways. But meanwhile, as investors, you want to kind of avoid some of these companies there, given that it's going to be very volatile. And of course, if you have exposure there, you want to kind of switch it out into some of the themes that are aligned with the policy tailwind of China, such as investment spending associated with the sustainability transition, such as some of the technology that would benefit as a result of manufacturing upgrade, especially in the semiconductor industry, or even perhaps even some of the Chinese tech companies that will become the beneficiaries of the rise of Asia's middle class. So I think these are where you want to be exposed to. And I think holding on to some of these sectors and exposure does have that policy tailwind to help you recover and ride the rebound.
Okay, so let's zoom into China's property sector. It seems like Chinese property crisis is far from over, with more defaults expected. So how soon do you think the Chinese property sector starts to turn around?
Yeah, that's a great question. I think what happened with the Chinese property sector is that it went through a self-deleveraging, and one is a deleveraging that it's kind of engineered by the government, because over the past many decades, Chinese developers have become very much debt laden. They went on a kind of a increase in over indebtedness. And a lot of the companies have gone on a lot of projects which are a lot fueled by debt rather than assessing the profitability of each project. So I think there is many property developers that become very unhealthy in terms of their strategy as a result. So this whole deleveraging process sort of weed out these developers that have been over-levered and does not have that profitability to drive growth for the future. So I think they are still in this process of deleveraging, I think in terms of the developers and also in terms of the government. But I think at the margin, it can continue on this year and it's very likely to. But, and of course, that means that property transactions will be fairly limited. That also means that demand of property would take a while because home buyers would still want to wait for a cheaper price. But having said that, when you look at Chinese savings, Chinese have very high savings rate. And typically what they will do is to buy property, just like in most Asian societies. So I think, of course, demand now is weak, but once come a point where the price is right, you would see the buyers would start to come in. So it's hard to tell when it will be, but of course, I'm sure many property buyers in China are waiting and at the sidelines with cash. So I think that there's always going to be a support for the property market in China. It won't be a free fall. There will be a support. So meanwhile, it's going to be volatile. You're going to get some price declines. Market's a bit weak, but I think come a time, the buyers will come in and provide that support. Really, because generally the savings rate in China is fairly high, and of course, property home ownership is always one of the key assets that the Chinese always want to accumulate. Great question.
Great, thanks. Okay, let's move on. Is there an opportunity in the Asian high yield space, in particularly China bonds?
Yeah, great question again. Yeah, well, I think Asian credit, especially China property or China bonds, have had a very difficult 2022 and also increasingly this few months, really because of that whole deleveraging that I've talked about amongst property developers and also among sentiment. But I think if you look at it, you want to be invested in the quality, in the developers or in the companies that will survive this deleveraging. Basically, you want to be invested in companies with very strong fundamentals. You want companies with low debt, with profits they're sustainable and rising, strong earnings prospects, good gearing ratios, high cash position. So you want to find quality companies, and there are, because at the end of the day, what you're going to get is a sort of a consolidation in the industry where the weaker players sort of get weeded out and the stronger players get stronger. So I think that's where we think in the long term the opportunities are. And of course, right now, Asia credit and particularly China credit is one of the areas in which you can get extremely high yield over for. So I think there is opportunity, but near term, at least for the next 1-2 months, it's going to be fairly volatile. But if you don't have exposure there, I think it's a good time to think about, especially in your bond portfolio, you want to consider Asian credit as one. And of course, you want to pick the good developers, the good companies. You want to diversify as widely as possible so that if 1 or 2 companies get in trouble, the entire portfolio is still fairly stable to give you that return.
Okay, so where do you see Asia this year or in the next 3 years? What will be the key drivers for Asia as a whole?
Yeah, well, I'm optimistic on Asia really because Asia is recovering very, very strongly in a post-pandemic world, and many parts of Asia is going to reopen. So I think consumption is going to pick up. That whole resumption of middle class, it's going to spending, it's going to kind of get a new boost. And where I think the opportunities are in Asia is along the lines of reopening place, at least for the next 3 years, because we know that the world is, especially in Asia and many parts of Asia, especially Southeast Asia, is going to live with the pandemic. So you're going to see more consumption, especially in tourism, for example, in travel, for example. So those are where I'm optimistic that there will be more normalization in terms of how people would want to live their lives. And I think that's where the opportunities are. And of course, in Southeast Asia is where I think the prospects are significantly, in which you have a rising middle class, but also the Southeast Asia consumers are very much digitally connected. So a lot of the spending is also done through e-commerce and through all these platforms, which also will be a way. The digital consumption is also another theme that will carry on in a post-pandemic world. But I think also because of the RCEP, the Regional Comprehensive Economic Partnership, the world's largest trade agreement, is going to reinvigorate investment spending once again in Southeast Asia. And I think that is going to be another interesting theme to look out for. In parts of, for example, there are a lot of investments that are looking to invest and start operations to do with nickel deposits in Indonesia, for example, so that because a lot of these nickel is going to be used for the electric vehicle batteries, which is going to take a very prominent role in the whole electrification of the transportation system across Southeast Asia. So where I think I'm optimistic on Asia, really because of the rising middle class, the consumption story, but also I'm getting more optimistic on Southeast Asia because of how Southeast Asia is going to rebound stronger in a post-pandemic world.
Next, with a more hawkish Fed and rising inflation globally, how do you see Asian techs in the next future?
Yeah, well, I think Asia tech, yes, Asia tech is being primarily Chinese tech generally has been affected by a few things. Last year was because of the regulatory uncertainty. And this year, of course, it is affected by rising interest rates. As interest rates rise, a lot of these growth sectors, particularly technology, are affected because they trade on high price earning multiples because of future growth prospect. And as interest rates rise, that price multiple contracts. And therefore, you saw big sell-off in the technology sector, not just for Asia tech, but also for US tech as a whole. So these are the headwinds that are facing the technology sector. But I think going forward, as how I've mentioned, that the pandemic has made our world much more digitally connected. And I think there are new themes around this whole digital world. Big data, artificial intelligence, 5G, 6G, and also metaverse is another new theme, virtual worlds in which people are being connected in. So these are the new digital teams that are kind of sprouting out and creating very interesting opportunities for investors to invest in. So I'm optimistic on the technology sector. Near term, these are the headwinds that they will face. But I believe that as interest rate expectations starts to moderate, and also even in Asia and China, where there will be greater regulatory clarity, hopefully in the second half of this year, then we might see a kind of rebalancing into technology again. But meanwhile, I think it creates a window of opportunity for investors to consider investments into Asia tech.
So, James, which market would you prefer to be invested in now?
Yeah, well, I think in terms of markets, right, we are actually overweight on Southeast Asia. So we like Singapore. We have been overweight on Singapore for the last 2 years. And Singapore is one of the best performing markets here to date across Asia. So Singapore, we like it really because of the dividend plays. Many companies in Singapore gives you good dividends, especially in this environment. You want companies that have strong growth that can increase their dividends amid inflation and amidst rising interest rates. And also, I think a lot of the companies, such as the banks, would also do well. So Singapore has the exposure there. But also, we continue to like the US market because we think the US market is always kind of the leader in many aspects. But also, we think there are selective opportunities in Europe as well because of the search for dividends. So I think at this stage, because of the uncertainty in markets, I want to put kind of a focus on value markets, and also on markets and that will give you that dividend income. So I would say Singapore is a good market to consider, some parts of Europe and also in the US.
All right. Okay, the next question. Correlation of traditional asset is already very high. So what other assets do you see that can be added to clients' portfolio to hedge against inflation? And how would you position that?
Yeah, great question. Well, what I think is that first and foremost, an investor should have a globally diversified portfolio across countries, across asset classes. So that's the first thing, because most investors have a very strong home bias. Typically, they just have a big exposure to a few companies that they like in their own home country. So I think investors should think of it in a global context. To have a globally diversified portfolio, that's number one. That's always the best line of defense against inflation or against any other risk out there. And of course, in terms of inflation, what one should do is first and foremost for the equity portfolio, you want to be exposed in sectors that will do well in an inflationary environment. So ultimately, you want companies, quality companies, good companies that have strong pricing power, that they are able to increase price amidst rising costs. So I think that's very important. But importantly, in terms of sectors, you want to look at energy sector, for example. Energy sector does well in inflationary environment. You want to look at financials, for example, because a lot of the banks benefit from rising interest rates. You want to look at quality companies in consumer discretionary, for example, because these companies can actually pass on the cost to their consumers, whether it's the luxury companies, etc. out there. And also, I think in terms of the bond portfolio, you want to be so-called exposed to bonds that can give you not fixed coupons, but coupons that are floating. And so in an environment of rising interest rates, the coupons can go higher. And also you want to be exposed also to some of the REITs for managers that can actually give you kind of a strong dividend income. So I think that's how I would want to kind of provide that sort of changes to the portfolio amidst rising inflationary environment. Thanks for the question.
Yeah, so let's move on to energy sector. So what rising geopolitical tensions in Ukraine could mean for them?
Yeah, well, I think in many ways, what will happen is that, of course, it's hard to predict the direction of the situation in Ukraine, but clearly it has created quite a bit of volatility, and which means that if the tension stays on, oil price would stay fairly volatile and high. So from that perspective, the energy sector as a whole, the global energy sector as a whole, would actually benefit because the price of oil is high. So that means that the energy company's margins are actually fairly strong. So that bodes well for energy companies. But also, I think ultimately, and investors also have to be fairly careful amid this geopolitical risk, because it's hard to predict what will happen there. But importantly, I think that the point I want to make is also that when you look through history of all these conflicts, typically geopolitical conflicts does not create a kind of a big sell-off in stock markets. Initially, yes, it might create some volatility, but if you look through it 3 months, 6 months, 12 months down the road, typically the markets recover as a result. And also, I think the last point I want to make is that the global companies' exposure to Ukraine or to Russia is actually fairly small. US S&P 500 companies' earnings to Ukraine is only less than 0.6%, to Russia under 1%. So I think exposure is not large, but the situation is fluid. But of course, it does drive some risk sentiment. But by and large, I don't think the issue in itself should derail the stock market rally, or it should not kind of cause economic recession as a result.
Thanks, James. Okay. Talking about gold, is gold a good diversification in 2022? If yes, why, and what is the ideal exposure of holding in a portfolio?
Yeah, well, I think for gold, it is a portfolio diversifier, but I don't think this year it's not going to be extremely a very ideal source of diversifier. Why do I say that? Because number one, yes, you get geopolitical uncertainty that brings the price of gold higher, but also you get another issue, which is rising interest rates. Gold is a non-interest bearing asset, so in a rising interest rate environment, gold price would actually underperform. So I think that therefore, I think this year I'm not bullish on gold, and I don't think one should allocate too much to gold, really because the effects of rising interest rates should outweigh the short-term geopolitical uncertainty, and therefore I think the rise in gold price is unlikely to go higher and higher from here on. So I think in that sense, yes, investors can allocate anywhere from 1 to 5% in gold, but I don't think one should go overly too much into gold, really for the reason that we are in a rate hiking cycle, and you should not be overly concentrated in zero interest bearing assets such as gold.
Thanks, James. So let's drill down further. What is the outlook for ASEAN countries this year or longer term?
Yeah, well, I'm optimistic on ASEAN this year because I think ASEAN is having a kind of a new dawn. And also, I think ASEAN, if it can grow at around 5%, which it normally does, and if you project that over the next 10 years, ASEAN is going to be the fourth largest economic bloc behind China, US, and the European Union. So it's going to be a very powerful force, economic force to watch out for. And I think what's driving ASEAN's growth over the long term is first, it's consumers. It has a young population, rising middle class, high aspirations for their life. And also, I think that productivity gains from the digital economy in ASEAN is going to be something that is going to be very powerful, whereby all these innovations that's occurred as a result of the pandemic, I think that would provide that a platform for future growth in Southeast Asia. So I think the long-term prospect for Southeast Asia is going to be bright. And of course, the near term, we think that this year, Southeast Asia is going to face a re-acceleration in growth. And I think many of the ASEAN economies will benefit from higher consumption and also the resumption of investment spending, which is going to be very beneficial for Southeast Asia.
That's great. Okay, one last question before we come to the end of the webinar. So James, what do you think about Malaysia?
Well, actually, I'm quite cautiously optimistic on Malaysia, actually. I think Malaysia actually can do very well because vaccination rates have improved. You are resuming life. I think consumption will get back to normal very, very, very soon. We think that Malaysia's GDP growth, the economy is going to grow at around 5.6%, which is quite a good rate. And I think that it's much faster than last year. And also, I think in terms of Malaysia-wise, it has been very strong in terms of its manufacturing sector, even through the pandemic. And I think that pillar of strength will continue on. And of course, if you get reinvigoration of investment spending in Malaysia, whether it's to address the chip shortages or to improve manufacturing capabilities, I think those will actually benefit Malaysia considerably. And of course, Malaysia being plugged into the RCEP, that will also benefit Malaysia significantly. So I think this year, 2022, is going to be a good year for Malaysia as things normalizes. And I think that I'm optimistic that growth is going to be very, very strong.
Good to hear, James. So, yeah, James, thank you very much for answering those questions. We will be grateful if you can provide a short summary or a key takeaway for today's webinar.
Well, I think this year it's going to be a year in which stock markets are still going to grind higher. It's going to be more volatile, but nevertheless, I think investors have to start your journey to be invested because cash yields you nothing, and you want to be diversified and invested in a diversified portfolio.
Thanks again, James, for the great presentation. It was a pleasure to have you with us today. Ladies and gentlemen, this comes to the end of today's webinar. We hope this session has been beneficial to meet your investment needs, and we look forward to supporting you in growing your personal wealth. If you have additional questions, you may speak to your dedicated relationship manager. We are happy to provide additional support. Hope to see you again. Stay safe and stay healthy. Thank you and have a great evening.